Let's now look at example number 17. A Limited has been incorporated recently. It incurred rupees 1 lakh on its incorporation. All right. So for incorporating, it incurred certain expenses of rupees 1 lakh. It has been charged to revenue in the very first accounting period. What does the word charged to revenue mean? It basically means it has been expensed in the P&L account. It has been recorded as an expense in the P&L account in the very first accounting period. In whichever period we actually incurred the expenses, we actually recorded the 1 lakh rupees as an expense in that period itself. The tax laws allow the deduction over a period of 5 years. The tax laws actually allow a deduction of this expense over a period of 5 years. If you recall, under the Income Tax Act, preliminary expenses are actually allowed as a deduction over a period of 5 years. And this is actually an example of preliminary expenses. Alright, the expenses that you incur at the time of incorporation of a company is basically regarded as preliminary expenses, which for accounting purposes, you have to actually expense it out in the very first year, whereas for tax purposes, it's allowed as a deduction over a period of 5 years. All right, let's actually see the deferred tax implication in this particular example. Let's actually start with journal entries. You might get irritated that I'm actually showing you the journal entries, but it's worth understanding it via the journal entries. All right, let us say in year one, for accounting purposes, for accounting books, I am actually going to basically record preliminary expenses as an expense in the P&L. Preliminary expenses, which is an item in the P&L, debit of 1 lakh rupees and credit cash of rupees 1 lakh. All right, so this is the journal entry that's going to be in the books of accounts. If I prepare a balance sheet, let us say I'm actually preparing an accounting balance sheet. If I prepare an accounting balance sheet for year one, I am basically actually going to show something called as preliminary expenses at zero value. There is going to be no value in the accounting balance sheet. In the accounting balance sheet, the preliminary expenses as a line item itself is not going to appear. All right, we are going to have a zero amount of preliminary expenses because the entire amount has actually been shown in the P&L. The entire amount has been actually taken to P&L, and therefore there's going to be no asset. All right, preliminary expense asset is going to be equal to zero. There's going to be no preliminary expense asset on the balance sheet. This is the accounting balance sheet, right? Now let's actually think of the tax books of accounts. For calculating deferred tax, we need the tax books of accounts as well, and we need to actually assume what the tax balance sheet would actually look like. In tax books of accounts, in tax books of accounts, if you think of it, the preliminary expenses is actually allowed as a deduction over a period of 5 years. The preliminary expenses is allowed as a deduction over a period of 5 years. So in year one, if you notice, 1 lakh divided by 5, 1 lakh divided by 5 is what is going to be allowed as a deduction, which is equal to 20,000. 20,000 is going to be allowed as a deduction for tax purposes. Therefore, although I have paid 1 lakh rupees, I am actually going to show a preliminary expense in the tax books of only 20,000. I am going to show a preliminary expense of 20,000 in my tax books of accounts. All right. So I am actually going to debit preliminary expenses of 20,000. All right. And then I have actually paid cash of 1 lakh, right? I have paid a cash of 1 lakh, but I am showing only 20,000 as an expense in the P&L in the tax books of accounts because only 20,000 is actually allowed as a deduction. All right, this is basically what is impacting my tax P&L. What is impacting my taxable income is only 20,000 rupees, and therefore I'm only showing 20,000 in the tax P&L. Now, the remaining debit is of 80,000 is going to actually sit as an asset, as an unamortized preliminary expenses. It's going to sit as an unamortized preliminary expenses. What does the term unamortized preliminary expense mean? It basically means that I've deferred the preliminary expenses. I've deferred it and I'm recording it as an asset. And over the remaining period, that will slowly get amortized to P&L. All right, I'm temporarily parking this as an asset in my tax books, and over the next 4 years, 20,000 additionally will keep getting allowed as a deduction. Every year for the next 4 years, I am going to recognize 20,000 as an expense from this 80,000. All right. The journal entry for that, we'll actually come to that in a moment. But what I'm basically doing is I am parking this as an asset in my tax books of accounts. I am basically parking this as an asset in my tax books of accounts because it is not allowed as a deduction in the first year. Therefore, I'm deferring it. I'm creating an artificial asset in my tax books of accounts, and that will be allowed as a deduction over the next 4 years. If I prepare my tax balance sheet at this stage, if I prepare my tax balance sheet will actually have an amount called as unamortized preliminary expenses. It's going to have something called as unamortized preliminary expenses of 80,000. All right. This is my tax balance sheet for year one. This is my tax balance sheet for year one. Now, in subsequent years, let us say in year 2 to year 5, in every subsequent year, year 2 to year 5, are we going to have any journal entry in the accounting books? The answer is no. There's going to be no further journal entry in the accounting books, but in the tax books, we will have an additional journal entry every year, which is basically charging preliminary expenses to P&L of 20,000. Every year, I'm basically going to move 20,000 into P&L. So I debit 20,000 of P&L and I credit the unamortized preliminary expenses, which is the asset item, by 20,000. All right, I'm basically going to do this journal entry every year for the next 4 years, year 2, year 3, year 4, and year 5. I'm going to record this journal entry every year for the next 4 years. And once I do that, the preliminary expenses asset will come down to zero. The preliminary expense asset will actually come down to zero. It will come down to zero. At the end of year one, it was 80,000. Each year, I'm crediting it by 20,000. Crediting it basically means that I'm reducing my asset, which therefore means that it will come down to zero by the end of fifth year. By the end of fifth year, it's going to come down to zero. All right. So these are going to be my journal entries in the tax books of accounts. So in the first year, I am not going to actually report a 1 lakh rupees of P&L in my tax books of accounts because only 20,000 is allowed as a deduction. Because only 20,000 is allowed as a deduction, I am going to credit my tax P&L by 20,000 only. The remaining is going to be parked as an asset. It's going to be parked as an unamortized preliminary expense asset, and that will be amortized. This asset will basically be amortized over the next 4 years. It's going to be amortized over the next 4 years. 1 year has already passed by. The expense is totally allowed as a deduction over a period of 5 years. Therefore, the remaining period will be 4 years. All right, this is basically similar to treating it as deferred revenue expenditure. Probably in your 11th grade or 12th grade, you may or may not have. If by chance you have learned something called as deferred revenue expenditure, this unamortized preliminary expenses as per tax books of accounts is similar to deferred revenue expenditure. It's actually a revenue expenditure, but you're deferring it and you're recording it in P&L over multiple years, which is what the tax laws require you to do. All right, as per accounting, you do not have the concept of deferred revenue expenditure. Every revenue expenditure is required to be recognized in P&L whenever you incur it, which is what we did in the accounting books. But in the tax books, we still have the concept of deferred revenue expenditure, where actually this expenses is going to be recognized over a period of 5 years, and therefore whatever is the unamortized portion that will continue to stay on the balance sheet. Whatever is the unamortized portion that will continue to stay on the balance sheet. Now let's actually sit down and calculate the deferred tax implication on this. The first step is carrying amount of preliminary expense asset. What is the carrying amount of preliminary expense asset? Carrying amount basically means that you need to actually look at your accounting books. You need to look at your accounting balance sheet. In the accounting balance sheet, did we have any preliminary expense asset? The answer is no. We don't have any preliminary expense asset. Reason being, the preliminary expense was entirely charged to P&L. Preliminary expenses was entirely charged to P&L, and therefore there is no asset remaining on the balance sheet. All right, so my carrying amount is basically going to be equal to zero. My carrying amount is going to be equal to zero. Second is I need to calculate the tax base of preliminary expense asset. Tax base of preliminary expense asset. What is the tax base of preliminary expense asset? I need to basically look at the tax balance sheet and I need to see what is the value at which it is appearing in my tax balance sheet. In my tax balance sheet at the end of year one, all these calculations again are being done at the end of year one. At the end of year one, the preliminary expense is appearing at a value of 80,000. Remember, this is basically an asset because it has a debit balance. All right. This is an asset because it has a debit balance of 80,000. All right, so the tax base is going to be equal to 80,000. The third step is I am going to calculate the temporary difference. The temporary difference is going to be equal to minus 80,000. 0 less 80,000 is equal to minus 80,000. The next step is what is the nature of this temporary difference? Now, if you think of it, carrying amount of zero, what carrying amount basically represents the amount of future economic benefits that I will actually receive from the asset. Carrying amount is basically the future economic benefits that I will receive from the asset or the future taxable income, right? It represents the future taxable income. In future, my taxable income is going to be zero on account of this. In future, my taxable income is going to be zero on account of this, but I am going to be allowed a deduction of 80,000. I'm going to be allowed a deduction of 80,000. Therefore, a temporary difference of negative 80,000 means in future, I am going to be allowed a deduction of 80,000. In future, I'm basically going to be allowed a deduction of 80,000. Therefore, the nature is going to be deductible temporary difference. It's going to be deductible temporary difference. I'm repeating, carrying amount of zero means that my future taxable income is going to be zero. Although my future taxable income is zero, I am going to be allowed a deduction of 80,000 against it. Therefore, I am basically going to have a net deduction of 80,000. I'm going to have a net deduction of 80,000 in future. And therefore, this is going to be a deductible temporary difference. This is going to be a deductible temporary difference. All right. If it is a deductible temporary difference, I am basically going to create a deferred tax asset. I will be creating a deferred tax asset, let us say at 30 percentage. So it is going to be 80,000 multiplied by 30 percentage, which is equal to 24,000. I'm going to create a deferred tax asset of 24,000. Why an asset? Because I'm going to receive a deduction in future. That receiving deduction in future basically means it is an asset for me. It's a benefit to me. Therefore, I record an asset, which is deferred tax asset. The next step is basically change in DTA. All right, do I have any DTA already recognized? The answer is no, because this is the first year. So change in DTA will also be equal to 24,000. All right, the change in DTA is also going to be equal to 24,000. And this is basically going to be equal to a benefit. All right, I need to create a DTA. I need to create a DTA, which means I need to debit asset. I need to debit deferred tax asset. The deferred tax asset should be debited and credit should basically go to deferred tax asset should be debited and credit should go to deferred tax benefit and credit to deferred tax benefit. All right, because we need to have a deferred tax asset of 24,000, I debit deferred tax asset of 24,000 and I credit a deferred tax benefit of 24,000. All right, these are the calculations for year one. All right, these are the calculations actually for year one. Ideally, I can plot these calculations from year one to year five. Ideally, I should be plotting these calculations from year one to year five to show how the deferred tax is actually moving over time. To show how deferred tax is actually moving over time, I can ideally plot it from year 1 to year 5. What I'm now doing is I am plotting it by each individual year. All right. Let us say I'm plotting it by each individual year, year 1, year 2, year 3, year 4, and year 5. Because it is actually allowed as a deduction over 5 years, I am plotting the deferred tax calculations for 5 years. All right. So let us actually redo these steps for all the periods. The carrying amount is going to be zero for every year. All right, the carrying amount in my books of accounts, there's going to be no asset in every year. All right, the tax base at the end of year one, we saw that it was 80,000. Every year, 20,000 is going to get amortized. Every year, 20,000 is going to get amortized, which means that 80,000 will keep decreasing by 20,000 every year. We saw the journal entry in subsequent years. In the subsequent years, the asset value is getting reduced by 20,000 each year. Therefore, 80,000 will become 60,000 in year two. It will become 40,000 in year three. 20,000 in year 4, and by the end of year 5, it will become zero. By the end of year 5, I would have claimed a deduction of the entire amount, and therefore I'm not going to have any unamortized deferred tax expense. The third step is calculating the temporary difference. What is the temporary difference? It's going to be negative 80,000, negative 60,000, negative 40,000, and negative 20,000, and then finally it's going to be equal to zero. Then I need to basically find out the nature of this temporary difference. All right, what is the nature of this temporary difference? All right, it's going to be a deductible temporary difference in all the cases. If you notice, it's going to be a deductible temporary difference in all the cases because the carrying amount represents future taxable income, which is zero. Tax base represents the amount that will be allowed as a deduction in future, which is a positive number, and temporary difference is therefore the net deduction that will be allowed in future. The net deduction that will be allowed in future, and therefore for all the years it's going to be a deductible temporary difference only. Why is the temporary difference going down every year? Why is the temporary difference actually going down every year? If you notice, at the end of year one, I had to receive a 80,000 net deduction in future. All right, I had to receive a deduction of 80,000 net in future. By year two, I would have already received 20,000 of deduction. In year two, I would have already received a deduction of 20,000 in year two. Therefore, the remaining future deduction is only 60,000. In year three, again, I would have received another 20,000 as deduction. Therefore, by now, 3 years of 20,000 has been received as a deduction already. So 60,000 has already been received as a deduction. And therefore, I am going to have a future deduction of only 40,000. Therefore, the temporary difference is getting reduced every year because every year I'm actually realizing the benefit. I'm realizing the deduction. Each year I'm already claiming the deduction for tax purposes, and hence my future deduction is reducing. What I'm going to be entitled in future is actually reducing in this case. All right, so then we have a deferred tax asset every year. Every year we're going to have a deferred tax asset. First year it'll be 24,000. Second year it'll be 60,000 multiplied by 30 percentage. Deferred tax asset is being calculated at 30 percentage, so that's 18,000. The next year it's 12,000. After that it's 6,000, and then finally it becomes zero. Then I need to plot the change in deferred tax asset. I need to plot the change in deferred tax asset for the first year because obviously I do not have any deferred tax earlier. The whatever is the deferred tax amount, that will also be the change in DTA. Whatever is the deferred tax amount, that will also be the change in deferred tax asset. All right. The second year, what we are saying is I need to have a deferred tax asset in my books of accounts of 18,000. I need to have a deferred tax asset in my books of accounts as 18,000, but I've already recognized 24,000 in my books. I've already recognized 24,000 in my books. Therefore, in year two, I need to reduce my deferred tax asset. I need to reduce my deferred tax asset by 6,000 rupees. An asset is appearing on my balance sheet at 24,000. I need to reduce that to 18,000. Therefore, I am required to reduce my asset by 6,000 rupees. Therefore, my change in DTA, I'm plotting it as negative 6,000 because my asset is reducing. When my asset reduces, I credit deferred tax asset and I debit deferred tax expense. All right. When my deferred tax asset is reducing, I credit DTA and I debit deferred tax expense. I have to credit deferred tax expense. All right. So that is the reason I'm plotting it as negative. Negative basically denotes that it is an expense. Positive represents that it is a benefit. All right. In the third year, my deferred tax asset is required to be 12,000. At the end of third year, I'm saying that the deferred tax asset should be 12,000, but I actually already have in my books of accounts 18,000 of asset. All right. After year two journal entries, my deferred tax asset in the books of accounts will actually be at 18,000. I need to bring it down from 18 to 12,000, which means that I'm reducing my asset by 6,000 again in year three. I'm reducing my asset again by 6,000 in year three. At the end of third year, my DTA on my balance sheet will actually be equal to 12,000. My DTA on the balance sheet will actually be equal to 12,000. Like I had mentioned earlier, this is basically a balance sheet value and this is basically a P&L value. All right, so my deferred tax asset at the end of third year is going to be 12,000. For the fourth year also, I need to reduce my deferred tax asset by 6,000, which is basically going to be the same, where I need to reduce it from 12,000 to 6,000. Therefore, I record a deferred tax expense of 6,000 in year 4. And in year 5, I need to bring the deferred tax asset down to zero. I need to bring the deferred tax asset down to zero because there is no future deduction that I'm entitled to. Every deduction has already been claimed. All right. 1 lakh was allowed as a deduction over a period of 5 years. 5 years have already passed by. So I'm not entitled to any more future deduction. I'm not entitled to any more future deduction. Therefore, I am actually going to bring down my DTA in the books to zero. But in my books, I already have a DTA of 6,000. Therefore, I'm going to write this off as 6,000 deferred tax expense. In the last year also, I'm going to write it off as 6,000 of deferred tax expense. So what you have over here is in year 1, we actually have a deferred tax benefit that we are recognizing of 24,000. And in the subsequent years, that is actually getting reversed. It's getting reversed over a period of 4 years by way of 6,000 of expense. All right. We're recording a DTA of 24,000 in the first year. That 24,000 basically represents that I need to basically get a tax benefit of 24,000 in the future years. I will get a deduction of 80,000 in the future years. On that 80,000, I will get a 30% tax benefit, which means that I will be getting a tax benefit of 24,000 in the future years. Of this 24,000, every year, 6,000 is actually getting realized. 6,000 is actually getting realized because every year, 20,000 will actually be allowed as a deduction. When 20,000 is actually being allowed as a deduction, I am basically reducing my deferred tax asset each year by 6,000 and it's finally going down to zero in year 5. All right, it's finally going down to zero in year 5. All right, if you notice, the sum total of all of this will basically be equal to zero. All right, you're recording a credit in the first year with a corresponding debit in the subsequent years. All right, this is how we're going to record a deferred tax in case of preliminary expenses. All right, this was an example where the carrying amount is actually equal to zero. The carrying amount is actually equal to zero, but a tax base actually exists. All right, carrying amount is equal to zero, but a tax base actually exists. So it's not mandatory that an asset should have a carrying amount. There can be certain items which do not have any carrying amount but have a tax base. All right, if you look at the heading of example 17, it refers to items with a tax base but no carrying amount. The carrying amount is zero, but a tax base actually exists. Let's actually quickly take a look at the solution of example 17. It says the tax base will be 80,000 as 20,000 being one-fifth is allowed as a deduction in tax laws over 4 years. All right, so 20 out of the total 1 lakh, one-fifth has already been allowed as a deduction. The remaining four-fifth is going to be allowed as a deduction in future. Therefore, the tax base for year 1 is going to be 80,000. All right, the tax base is not going to remain constant over all the 5 years. The tax base is 80,000 for year 1, but it keeps reducing by 20,000 each year. All right, so that was the solution for example number 17. We are also actually done with example number 18, which is a replica of example number 17 itself. All right, it's just a different nature of expense. The expense is public issue expenses. In example 17, we were actually looking at incorporation expenses or preliminary expenses. Over here, we are actually referring to IPO expenses. When a company is going for IPO, the expenses that it incurs is actually treated differently between accounting and taxation, and that could result in deferred tax, but it's exactly the same as example number 17. All right, an entity may have written off the public issue expenses in the very first year. This is for accounting purposes. For accounting purposes, we're going to recognize the IPO expenses as an expense in the very first year. Whenever you record it, you're going to record it. Whenever you incur it, you're going to record it as an expense. Therefore, there won't be anything on the balance sheet. The carrying amount for these expenses will actually be equal to zero. However, tax laws permit the deduction over 5 years. Therefore, the temporary difference will exist until the deduction deduction is completely claimed under taxation laws. All right. So therefore, temporary differences will actually arise until it is finally claimed. All right. Exactly the same example as example 17, just that nature of expense is different. All right. So with that, we're done with both example number 17 and example number 18.